Have you ever felt your hard-earned savings shrinking right before your eyes, even when you're doing everything right? I've spent my whole life watching what people do with money, not just investors, not just governments, but regular folks who save, who worry, who hope things don't go off the rails. And I'll tell you today, I'm seeing something explosive that reminds me of a very old, dangerous pattern. The U.S. government is doing something very few people dare talk about directly. It's quietly, intentionally letting the value of the dollar slip away right under our noses. Now, I don't say that to scare you. Fear doesn't make good investment decisions. But when I see governments take on too much debt, print too much money, and act like prices don't matter, well, I've seen this movie before, and it doesn't end well for the folks holding on to too much cash. Let me tell you something simple. When you hold cash, what you're really holding is a promise. You're saying, I trust the government not to make that promise worth less over time. And right now that promise is weakening quietly, slowly, but certainly you see it when you buy groceries, you see it when you try to rent a house, you see it every time your savings earn 1% while your costs go up 5%. That's what I mean by devaluation. It's not conspiratorial, it's arithmetic. And arithmetic has no emotion. I was born in 1930 during the Great Depression. I've seen good money turn bad and bad policies pretend to fix it. I've lived through times when a dollar truly mattered. You could fill your tank and buy dinner for your family with a $5 bill. Today, $5 might not buy you a sandwich. That's not your imagination. That's policy. Now, when I say intentional devaluation, I'm not accusing anyone of some secret plot. Governments don't stand in front of microphones and say, we're going to destroy the dollar. Instead, they do it indirectly, with deficits, with stimulus, with interest rate decisions, with the slow erosion of fiscal discipline. Over time, it adds up to the same result. Your dollar buys less, always has, always will, unless you do something about it. And that's what we're here to talk about today. Not panic, but understanding. Because if you understand what's happening, you don't have to be afraid of it. You can prepare, you can protect yourself, and maybe even take advantage of what others are too emotional to see clearly. Now, let's be honest about what's going on in Washington. The United States government owes over $30 trillion. That number's so big, it doesn't even mean much to most folks. But think about this. If you spent $1 million every single day, it would take you more than 80,000 years to spend $1 trillion. So when I say 30 trillion, that's a mountain you can't climb. There's only one way to get out from under that, let the money itself shrink in value. And that's what's happening. When the government borrows and spends excessively, then later pays back the debt with cheaper dollars, they win and you lose. That's the quiet transfer of value from savers to spenders. From the disciplined to the reckless. From the future to the present. It's invisible, but deadly for those who save the old-fashioned way. Now, I've always said don't bet against America. I still believe that. This is the most innovative, resilient, and optimistic country on earth. But that doesn't mean you should bet everything on the dollar. The United States can prosper over time while the purchasing power of its currency still falls. Those two ideas can live side by side, and they have for decades. So what does it mean for you, the everyday investor, the saver, the person who's worked 40 years building a nest egg? It means you've got to think about what kind of assets survive when governments chew away at money's value. Because here's the uncomfortable truth. Cash might feel safe, but in a world of deliberate inflation and currency manipulation, cash is the riskiest long-term asset you can hold. I know that sounds backwards. People think cash is protection. They think, if I sell everything and hold dollars, I'm safe. That's true only for the very short term. Over time, that dollar in your pocket is quietly melting away like ice in the Nebraska sun. You can't see it every day, but give it a decade and the puddle is all you will have left. Charlie and I have talked about this for years. We've both seen people lose fortunes not from stock market crashes, but from doing nothing while inflation ate their savings alive. You don't need a crash to lose half your wealth. All it takes is steady devaluation and a few years of bad monetary policy. You know, when the government says 2% inflation is healthy, that means your money loses half its value roughly every 35 years, even in good times. But lately we've seen 5%, 6%, even more. At that rate, your savings cut in half in about 12 years. That's not some academic statistic. That's your children's college fund, your retirement, your peace of mind, gone before you even notice. Now, you might be wondering, if the dollar is slowly being devalued, why would the government want that? Because debt is easier to pay back with cheaper dollars. Inflation makes old obligations smaller in real terms. It's like owing someone 10 apples, but each year the apples get smaller. You still hand over 10, but it costs you less. And if you're the world's largest debtor, that's a pretty convenient trick. But don't get me wrong, nobody in Washington puts that on a billboard. They don't have to. Economists have fancy words for it: monetary easing, quantitative support, stimulus injection. But when you scratch off the labels, it's the same old thing, printing money to solve political problems. It's been happening since the Roman Empire. It always ends the same way. Currencies lose trust, and people who hold real assets end up the winners. Now, I'm not saying go bury gold in your backyard. What I'm saying is understand the environment you're in. The goal isn't to hide from the system, it's to play smarter within it. You don't beat inflation by complaining, you beat it by owning things that outlast paper promises. That can be businesses, productive assets, real property, things that hold value no matter what politicians do with interest rates. We'll get into specific ideas later, but first I want to take you behind the curtain to show how we got here, how governments around the world reached the point where printing money became the default solution for every crisis, every election, every problem. It didn't happen overnight, and it didn't happen by accident. You know, one of the most dangerous things in investing or in life is to misunderstand the system you're living in. People think the dollar loses value by accident, like a car slowly rusting in the rain. But that rust isn't an accident. It's policy. It's the price of decisions made years earlier, one by one, until suddenly you realize the vehicle you trusted isn't as strong as it used to be. Let me walk you through what's really happening. Because if you only listen to the headlines, inflation cooling, the Fed has things under control, the economy's resilient, you'll miss the structural story hiding underneath. And that story is about debt, incentives, and the quiet cooperation between the U.S. government and the Federal Reserve. Now, the government has one main problem. It always wants to spend more than it earns. Sounds familiar, doesn't it? Just like a household that can't stop reaching for the credit card. Every administration does it. Republicans, Democrats, doesn't matter. Promises are expensive. Wars are expensive. Pandemics, tax cuts, infrastructure, social programs, all of it adds up. And at some point, the math stops working. When you have that kind of imbalance, you get three choices. One, raise taxes. Nobody likes that. Two, cut spending. Even fewer people like that. Or three, print more money. And guess which one wins every time? Printing money sounds complicated, but it's just the creation of new dollars by the Federal Reserve buying government debt. When the Fed buys treasury bonds, it's essentially the government lending to itself. Fresh money flows into the system, and suddenly everything looks fine for a while. But here's the trick. Those new dollars don't increase real wealth. They just divide the same pie into more slices. So each slice of each dollar becomes worth a little less. That's devaluation. It's like taking a bottle of fine wine and adding water each time your guests show up. Eventually, it's all water, just looks the same from a distance. This process has been going on for decades. After we left the gold standard in 1971, the dollar stopped being fixed to something real. That gave politicians the flexibility they could finance anything by creating new credit. But it also meant discipline went out the window. A dollar no longer had to represent anything tangible. It became a promise floating on faith. Now, Faith is powerful until it isn't. The entire global financial system runs on trust in the United States, in its government, its economy, and its central bank. The dollar isn't just America's money. It's the world's reserve currency. That's a privilege, but also a trap, because when the world believes your currency can't fail, you start to push your luck. You know, I once said that when you give a man a gun, he may rob a bank, but when you give a man a printing press, he can rob the world. That's what inflation really is, a silent tax on everyone who uses dollars, whether they live in Omaha or in Singapore. It's a slow redistribution of value from the cautious saver to the careless spender. And the Federal Reserve, well, they're in a tricky spot. Their official job is to manage inflation and employment. But politically, they can't let markets crash. They can't let unemployment spike. So every time anything wobbles, they respond by printing more money, lowering rates, and reassuring Wall Street that liquidity will always be there. That sounds comforting, but it feeds the very disease they claim to be curing. Think about what's happened in the past few decades. Interest rates fell close to zero. Companies borrowed more. Governments borrowed more. Consumers borrowed more. Debt became almost free. And when money is free, discipline disappears. You stop asking, is this investment productive? And start asking only, can I get more of it? That's how bubbles form in housing, in stocks, in crypto, you name it. Easy money creates easy confidence. It feels good until it suddenly doesn't. And when the time comes to raise rates or cut liquidity, everyone screams. So what do policymakers do? They flinch. They ease again. Slowly but surely, that becomes the default mode of an economy: reward risk takers and punishes savers. You might wonder, why not just let the market reset? Because no administration wants to be in office when that happens. They all prefer to kick the can a few more miles down the road. Devaluation then becomes the most politically painless option. Inflation quietly eats away at the debt. Nobody votes it down because it feels invisible. Here's how I think about it. Imagine you owe your neighbor $100 and you can't pay. You could either admit failure or print new dollars so that $100 tomorrow only buys $80 worth of stuff. Congratulations. You just paid your neighbor back on paper and cheated him in reality. That's what the U.S. government is doing right now, just on a $1 trillion scale. Now, this doesn't mean America's collapsing. Far from it. The country's productive engine, its businesses, entrepreneurs, and innovators, is stronger than ever. But that engine runs on a fuel that's slowly watered down. When governments borrow too much and central banks try to make everyone happy, the purchasing power of ordinary people takes a hit. And because the dollar is the global standard, the rest of the world feels it too. When the U.S. prints more money, emerging markets suffer, commodity prices rise, and other currencies get distorted. Everyone's forced to play the same game, keep their currencies weak so exports stay competitive. That's what economists call the race to the bottom. Now, I want you to see something clearly. This system doesn't collapse overnight. It erodes. It's like termites in a house, quiet, invisible, year after year. Until one day, a storm comes, and then you realize the beams are hollow. That's how financial crises begin. Not from sudden shocks, but from long-term rot. So when I say the dollar's being deliberately weakened, I mean it's structurally built into the incentives. Politicians need inflation to manage their debt. Central banks fear deflation because it makes debt harder to pay. And markets demand constant liquidity. These forces together make true stability almost impossible. But here's the hopeful part. Once you understand this, you stop being the victim of it. You stop holding shrinking cash, thinking it'll save you. You start owning what governments can't print: productive businesses, strong brands, scarce resources, and real assets. The economy might twist and turn, but those things have an anchor in reality. That anchor's what protects you when money itself becomes elastic. See, my goal is never to frighten you. Fear makes you sell at the bottom and buy at the top. My goal is to wake you up, because the people who adapt early are the ones who thrive through every cycle. You don't have to predict the end of the dollar. You just have to plan for a world where a weaker dollar is the default, not the exception. And that's where we're heading. Slowly but surely, dollar dominance is entering a new phase, not collapse, but compromise. Other currencies and assets are starting to play bigger roles, from gold and commodities to emerging market reserves. The smart money's diversifying quietly, not out of patriotism or panic, but prudence. And that's what I want you to start thinking about. When institutions fail, it almost never starts where people think it will. It's not the headlines that hurt you first, it's the slow leak under the floorboards. By the time folks realize something's wrong, the water's already knee-deep in the living room. That's exactly how financial failure spreads from government policies to your own kitchen table. It doesn't come announced. It comes through the price of milk, the rent you pay, the mortgage you can't refinance, the 401k balance that quietly stops growing even though you're still working just as hard. Let me paint you a picture. Imagine a young couple in Omaha. They've both got jobs, 2 kids, a mortgage, and a modest savings account, maybe $25,000 they've built up over years. They feel responsible. They don't gamble. They don't buy crypto. They don't trade stocks for fun. They just trust that if they save and stay disciplined, they'll be okay. Now, inflation ticks up to 6%. Their wages rise by only 3%. Groceries go from $150 a week to $220. Their mortgage payment doesn't change yet, but property taxes, insurance, and utilities are all a little higher. Within a year, they've eaten through $3,000 of purchasing power without even noticing. They're not reckless. The system around them simply devalues the effort they put in to every hour of work. And it trickles down in strange ways. Pension funds, for example, rely on stable return assumptions. When central banks keep rates too low for too long, those funds can't earn what they need safely. So they go searching for yield, they buy riskier assets, maybe real estate projects, private loans, even derivatives. It works fine until markets wobble. Then what? Millions of retirees discover their pensions are far more fragile than they were promised. That's institutional failure turned personal. Banks feel it too. When they can borrow at 2% and lend at 5%, money's easy. But when inflation spikes and rates climb to 7%, the cost of capital crushes their old loans. Suddenly, some regional banks are underwater, like we saw in 2023. They promise your deposits are safe, but the numbers on their balance sheets say otherwise. And that fear spreads faster than truth. Depositors see one bank collapse and run to withdraw their money. Then another bank gets wobbly. The Fed steps in, backstops them, prints more money to restore confidence, and ironically, that restarts the cycle of inflation again. That's what I call an institutional circular firing squad. Everyone's solving the short term by worsening the long term. Charlie used to say, "Show me the incentive and it'll show you the outcome." Well, the incentives today say borrow, leverage, and inflate. Governments borrow to win elections. Corporations borrow to boost stock prices. Consumers borrow to maintain lifestyles. And when it all gets too heavy, the institutions inject liquidity, which means printing. Now, who pays the real price? The disciplined, the saver. The person who worked a lifetime carrying no debt suddenly finds their dollar shrinking, while the over-leveraged borrower gets bailed out. That flips moral logic upside down. It punishes prudence and rewards recklessness. And over time, society internalizes that message. Don't save, spend, don't plan, speculate. That's how institutional weakness becomes cultural weakness. Let me tell you something from experience. When people lose faith in money, they don't just lose faith in banks or central banks. They lose faith in each other, because money is just trust in tangible form. It's a piece of paper that says, "I believe you'll honor this tomorrow." When that belief erodes, So does the fabric that holds together trade, contracts, and human cooperation. You don't need panic in the streets for trust to erode. You just need frustration repeated often enough. Families start cutting corners. Businesses take shortcuts. Governments fudge statistics to look stable. The truth gets blurred, so everyone can sleep a little easier. But deep down, the foundations are cracking. You can see it in behavior. Look around. More people day trade than ever before. Everyone wants to beat inflation in 3 months. That's not greed. It's fear disguised as optimism. They feel the dollar losing ground, so they chase speculative hope. Others pull their money out of banks, store gold at home, or buy houses, not because they need them, but because they don't trust cash anymore. Behavior always reveals the truth before data does. Let me give you another slice of reality. In the corporate world, cheap money hid inefficiency for 15 years. Companies that should have gone bankrupt survived because debt was easy. When interest rates rose, we suddenly discovered who was swimming naked, and there were a lot of swimmers. That reckoning isn't over. You'll see more defaults, more layoffs, more consolidation. Regular employees will feel it long before boardrooms admit it. This is what I mean when I say institutional failure spreads. It starts at the top but lands at the bottom. Every time the government manipulates the currency to solve its own debt problem, the cost is paid by ordinary people who can't hedge or diversify. Inflation doesn't ask permission, it just arrives. What's especially dangerous is the psychological toll. When you've been told all your life that saving is a virtue, then suddenly saving hurts you. People get confused. They stop trusting advice. They stop planning. They disengage. And that confusion creates opportunity, not for them, but for the people selling promises. You'll see waves of speculation, new safe assets, miracle products, quick fix investments. Most of them will vanish the moment real fear hits the market. The lesson? Don't expect the cavalry to come from Washington or Wall Street. They're part of the problem, not the solution. Real strength begins with individual understanding, with you realizing no one can print away the laws of economics or compound interest. Now, I know this sounds harsh, but I'm not a pessimist. I'm a realist. The Americas recovered from every major setback, even when the institutions looked broken. The key is recognizing that the system itself adjusts by transferring pain from one group to another. And right now, that pain is moving from the government's balance sheet to your household. The next phase is almost always the same. After trust begins to erode publicly, after savings wither and faith in the dollar wobbles, we enter what I call the emotional cycle. That's when people start making irrational financial decisions driven by fear rather than logic. They dump stocks at the bottom, hoard cash at the wrong moment, or chase whatever shiny thing promises safety. And that cycle, my friend, is what turns a controlled problem into a genuine crisis. You know, history doesn't repeat exactly, but it sure rhymes. Every financial storm I've seen follows the same old tune. Too much confidence, too much debt, then too much fear. I was born in 1930, right in the middle of the Great Depression. Back then, people didn't just lose money, they lost faith. When banks failed, trust disappeared. That experience shaped how I've thought about risk my whole life. Then came the 1970s. Inflation went wild after we left the gold standard. Prices doubled, wages couldn't keep up, and people stopped trusting paper money. It taught a hard truth. Cash can betray you faster than any crash. Fast forward to 2008, different era, same mistake. Too much leverage, too much fantasy. When the music stopped, even the smartest people froze. Governments printed money to patch the wound, but that rescue also taught institutions that never have to take full responsibility again. The pattern never changes: promise too much, borrow too much, then blame the system when it breaks. Each cycle ends with the same lesson: patience, prudence, and owning real assets always win over speculation and speed. If you understand that, you stop fearing history and start learning from it. Every crisis clears the field for disciplined investors. Every panic ends up being tomorrow's opportunity for those who remember what pain feels like and keep their temperament steady when it returns. I've lived through every major economic shock since the Depression, and one thing stays constant: people overestimate short-term chaos and underestimate long-term recovery. The smart money doesn't chase headlines. It waits for the dust to settle. That's why I always tell folks, don't try to time the storm. Just make sure you're holding an umbrella that works when it rains hardest. Real businesses, productive land, assets that generate cash no matter what the government does with money. And here's the beautiful irony. Every time trust in currency shakes, faith in human ingenuity grows stronger. America doesn't just survive these cycles, we reinvent through them. That's the real lesson. History whispers to those wise enough to listen. People think market crashes happen overnight, but they don't. They build slowly, like pressure under a fault line, and then one small shake makes everything move at once. It starts with complacency. Things feel good, money's cheap, everyone's confident. Then comes leverage. Borrowing becomes easy, and people confuse debt with wealth. After that, distorted prices stop reflecting reality, speculation replaces reason, then you see strain. A bank wobbles, a company fails, and everyone pretends it's contained. It never is. Liquidity starts drying up. That's when confidence snaps and panic takes over. People sell not because they think, but because they're scared. The government steps in, prints money, cuts rates, but you can't fix fear with liquidity. Trust takes time to rebuild. Then comes disillusionment, the hard truth that the system wasn't as stable as everyone thought. And finally, the reset. The weak fail, the strong adapt, and discipline is reborn. That's capitalism rebalancing itself. The danger today is that we've interrupted this natural reset too often. Each bailout delays the lesson. Each rescue increases dependency. We don't erase pain, we just defer it. And the bill always comes due. But don't mistake these cycles for the end of the world. Every crash passes, every panic fades. Those who own good, productive assets and keep their heads, while others lose theirs, they come out stronger every time. The real edge comes from spotting these stages early, before the crowd panics. When complacency peaks, that's your signal to tighten up. When panic hits hardest, that's when true value appears. That's why I always keep cash ready, not out of fear, but for opportunity. Crises don't destroy wealth, they redistribute it to those patient enough to wait through the storm. And remember, every great fortune I've seen was built not predicting the crash, but enduring it with the right assets and unbreakable temperament. People always ask me, Warren, what should I do when the dollar's losing value? My answers are the same as it's been for 70 years. Stick to sound principles. Governments change, markets swing, but discipline always pays. First, don't hoard cash. You need some for peace of mind. Sure, 6 months, maybe a year, but holding piles of dollars is like holding ice cubes in the sun. They melt. Instead, own productive assets, businesses, land, or anything that creates real value. Second, own things governments can't print. Stocks in good companies, real property, and resources outlast inflation. A dollar bill can lose value overnight, but people will still drink Coke, eat food, and use energy tomorrow. Third, know your circle of competence. You don't have to predict currencies or chase fads. Just invest in what you truly understand and can hold through rough waters. Fourth, think in decades, not days. Inflation punishes the impatient. Compounding rewards the calm. Every crisis feels endless until the next boom proves it wasn't. Fifth, control your behavior. You can't stop inflation or rate hikes, but you can stop yourself from panicking. Don't interrupt compounding just because the headlines scream. And last, remember, real wealth isn't money. It's ownership of things that make life better: businesses, skills, relationships, patience. A weakening dollar can't touch those. So when others fear, stay steady. When others hoard, stay invested. Because governments can print currency, but they can't print character, calm, or common sense. Those are your real assets in any economy. You know, the beauty of these rules is they work in any currency, any era, any crisis. They're not about beating the market. They're about beating human nature, your own included. That's why Charlie and I never chase trends. We own timeless businesses and let time do the heavy lifting. Devaluation changes paper values, but real cash flow endures forever. And here is the secret. No one tells you when inflation rages, that's exactly when productive assets shine brightest. Your patience today becomes your fortune tomorrow. But you asked about currencies specifically. So let me give you three. I'd consider over dollars right now, plus how much of your portfolio they deserve. First, the Swiss franc. Switzerland hasn't played currency wars. They maintain discipline other nations envy. The franc holds value through chaos because it's backed by real stability, not promises. 10 to 15% allocation makes sense for most folks. Second, the Japanese yen. Japan carries massive debt too, but their central bank moves slower, more predictably. Yen strengthens. When global panic hits, dollars' safest havens shine brightest. Another 10% works well. Third, not a currency exactly, but gold through trusted miners or ETFs. Governments can't print gold. When dollar trust wanes, gold doesn't just hold value, it pulls ahead. 5 to 10% gives real protection. Now here's the portfolio math. If you're 60% in productive businesses, 20% cash equivalents, then 10 to 20% across these three currency hedges leaves you bulletproof. You don't need exotic emerging markets or crypto roulette. Stick to proven stores of value, nations and assets with track records spanning centuries. Charlie always said, never bet your life savings on something you can't explain to a 12-year-old. Swiss franc, yen, gold, all pass that test. These aren't trades. They're insurance against the very devaluation we've discussed. When dollars weaken most, these strengthen automatically. That's how you turn government policy from headwind to tailwind. You know, after a lifetime of market cycles, depressions, booms, and everything in between, I've learned the single hardest part of investing isn't intelligence, isn't information, isn't even timing. It's temperament. Two people can sit side by side with the exact same facts, the same opportunities, yet one stays rock steady calm while the other panics and sells everything at the worst possible moment. And fear, my friend, that raw emotion destroys real wealth faster than any market crash, any bout of inflation, or any government policy ever could. I've watched it happen 1,000 times. Yes, right now the government is devaluing the dollar, printing money like it's going out of style, and stretching public trust thinner than a razor blade. But that doesn't mean you're powerless or helpless. Far from it. It just means the game we all play requires stronger patience, deeper conviction, and a willingness to ignore the noise. You can't control what happens in Washington or on Wall Street. You can't stop politicians from making promises they can't keep. But you can absolutely control your own reactions, your own decisions, your own steady hand at the wheel. Think about the folks who came through the Great Depression with me as a boy. They didn't have fancy spreadsheets or AI predictions, but they had grit. They understood that governments rise and fall, currencies stretch and snap. But the habit of hard work, smart ownership, and calm thinking, those endure. Fast forward through my life, the 1970 stagflation that crushed savings, the 2008 meltdown that froze the world, every bubble and panic since, and the pattern stays crystal clear. The steady temperament always, without fail, outlives the panic. You know, I've seen every kind of economic chaos imaginable since the Depression wiped out fortunes overnight, through wars that shook global trade, through inflations that made millionaires feel poor, through tech revolutions that created overnight billionaires and then humbled them. And through all of it, one truth holds steady as Nebraska farmland: the calm, disciplined investor always comes out miles ahead. Fear shouts the loudest right in the heat of the moment. It fills the airwaves and social feeds. But patience whispers the longest. It builds quietly while everyone else exhausts themselves chasing shadows. That's exactly why I sleep like a baby every single night, no matter what the Dow does or what the Fed announces. Not because markets are perfect or governments are wise, but because I know temperament is unbeatable. It's the ultimate edge. Governments can print endless streams of currency. They can manipulate rates and whisper sweet nothings to voters, but they can't print genuine wisdom. They can't print resilience. They can't print the quiet strength that says ill wait while others flail. Picture this: your neighbor's panicking, selling homes at a loss, dumping stocks into the abyss, chasing whatever guru promises quick safety. You sit tight with productive businesses, real property, assets that churn cash through every storm. When the panic peaks, that's when your opportunity explodes. History proves it every single time. So take this deep to heart, write it on your wall if you have to, when the next storm hits full force, and it will. Be the steady hand at the helm. Be the one who sees through the fog while others chase mirages. Your future self, 10 years from now, looking back, will thank you from the bottom of his heart when others are still digging out from their panic-driven mistakes. Because in the end, no currency, no policy, no crisis can defeat a temperament built on rock-solid principles. That's the one investment, the only investment, that truly never depreciates. If you found this breakdown gripping, make sure to like, share, and subscribe. Your support keeps this channel soaring.